Okay, that's recording. So you could actually have a, oh, hold on, I'm getting a little bit of feedback here. I'm going to turn off mics. Okay. So you could technically keep all your cash in your building, right? You could do that if you wanted to. But the reality is that it's not very safe to keep your cash in your building. The other thing is that, oh, hold on one second. Everyone mute their mics, please, because I'm getting feedback from somebody.
That's me. Sorry.
Thank you. So what happens is that hold on one second. Okay, so what happens is that we don't want to keep our cash in our building, right? The bank helps to keep our cash safe. The other thing is that when the bank keeps our money, they send us a statement every month, and the statement is not sent to us as a means of them kind of saying, "Hey, we did this for you to show you your money." The bank does it on their behalf in order to show themselves the liability, what they owe. So when we're looking at this, when you're looking at a bank statement, the bank produced it as a form of liability for them. And that's why when you look at the debits and credits, it doesn't make sense with debits and credits when you're thinking about your bank account being an asset. They didn't produce that statement for you as your asset. They produced it for them as their liability. Okay. Now, but that's part of the reason why we use banks is because they do produce that statement. So now we can go through the process of doing a bank reconciliation in order to learn if our balance is correct or not. So that's what we're basically trying to do. We're trying to prove that our balance is correct. Okay. So let's see. Now, I know that most people do everything through electronic funds now, but even if you work through a company and you do a lot of stuff, hold on. It is break time. And you do everything through an electronic system in a company, you still have to do a bank reconciliation. So even though you may not get a paper statement anymore, you're going to go in and you're going to print out a paper statement. However, most companies still get a paper statement and they still get their checks returned to them. That's part of like the control system. Okay, so we are going to learn how to do a bank reconciliation. And with learning how to do a bank reconciliation, it's a bunch of rules again. We've got a bunch of rules and processes to follow and steps, and you do one thing after another thing, after another thing, after another thing. So you're going to want to make notes of this. You're going to want these on your cards. Because it's very different than anything else we've done. Okay. All right. So this is an example of a bank statement. Now you are going to get problems where everything's in a paragraph, and you're also going to get a problem in your homework. Excuse me. Apologize. You're also going to get a problem in your homework that not only includes this bottom part of the bank statement here where it shows checks and debits, deposits and credits, but you're going to get a previous month's bank statement. I mean, not bank statement, bank reconciliation, a bank statement like this, and then you're going to do the next month's bank reconciliation. So when I take you through this process of what you do, when you do your homework, remember, you're going to be looking back to the prior month's bank reconciliation and checking the things off of that list first. This isn't going to make sense right now, but just write that down. That if they're showing you a prior month's bank reconciliation, you're going to go through that and make sure that everything's checked off there. And if there's anything in transit or outstanding, those are going to be the first things you're going to list on your new bank reconciliation. Okay. All right. So the bank reconciliation, what we're concerned with here are the checks and debits. And you can see those here in that left-hand bottom box. And then the deposits and credits in the middle box, okay? And then we are concerned with what they're saying are balances of the statement, 18,907.48, okay? So Debit things might be bank service charges, might be non-sufficient funds fees, credit card fees, any checks that we've written, okay? And then credit memorandums will be any notes that they've collected for us. So some people might go directly to our bank and pay, or it might be interest that we've earned. Now notice, they say debit for things that are coming out of our account and credit for things that are going into our account. But cash is an asset. So really it's opposite, right? That's because, remember, they're doing this on their benefit, as this is a liability for them, not for us as an asset, okay? So don't get too hung up on that part. All right, so this is what you're looking for when you are doing a bank reconciliation, the reconciliation items, okay? And you're looking for deposits in transit, outstanding checks, bank memos, and errors. And the thing is, these all occur because the first three occur because of what they call our time lags. So for instance, let's say it's March 31st and you're at work and you're doing your bank deposit. You get your bank deposit all ready, and you look at the clock and you're like, oh, great, it's 6:30. The bank's closed. So you finish your deposit, you take your deposit to the bank, and you put it in the night drop box. Okay, so now the bank's not going to get it till the next morning, the April 1st. Or you it's April 1st and you have a bunch of checks come in and they were actually for the month of March. So you do a deposit slip for March, for the month of March in your computer, but you don't take it to the bank till April 1st. Okay, that would be deposits in transit, because the bank is going to print your statement at 11:59 p.m. on the 31st of March. They're going to print your bank. So when your bank statement comes, it's not going to show those deposits on there. Same thing with, you're going to write checks after your bank statement is printed on March 31st, and they're going to be for March, and they're not going to be on the bank statement. So they're going to be outstanding checks. And the reason why that happens is because when the last day of the month arrives, March 31st, let's say, you don't close the books on March 31st. As an accounting person, you're actually running 2 months at one time. So you start doing the work for April. You got to keep your stuff separate. You got to keep April and March separate. So you start running your books for April on the side, right? But then you're closing out, probably for 1 to 2 weeks, you're closing out all of the stuff for the month of March. You're doing the rest of the transactions for March before you close the books for March. So you're going to get invoices in the mail that are for the month of March that you're going to have to post to March, and then, you know, several days after March 31st, because some people are mailing those bills on March 31st. So you have to give time for those to arrive. You're also going to get checks in the mail that are payments for the month of March. Maybe you have some things you have to pay that are for the month of March, things of that nature, right? So that's where you have to keep the month of March open until you kind of get to that point where you round everything up and then you close the month of March. So that's where you kind of have 2 months that are operating at the same time. So that's why we can have these deposits in transit, these outstanding checks, bank memos, and then of course the errors that come into play. All right, so here's the process for doing a bank reconciliation. Now, this slide shows it side by side. It's really not done side by side. You really do the bank part on the top, and then you do the book part on the bottom. And I'm going to look at our chapter right now and tell you what page is a good example. But this is, we're going to just look at what the steps are right now. I'll tell you what page is a good page for an example of a bank reconciliation, though. Top of page 7-22, 722. There's a bank reconciliation there for Laird Company. Okay. All right. So the way that we start the statement is on the very top, we have, we do everything that has to do with the bank. Okay. So we start with the balance per bank. Okay. And then we're going to add for any deposits in transit. We're going to subtract for any outstanding checks. And then we're going to either subtract for any errors that the bank makes. Now, I'll tell you this right now. It is rare, very, very rare that the bank makes mistakes. Do they make mistakes? Once in a blue moon, they do. But they have some pretty intense auditing systems in place with people checking people. So it's pretty rare that we see that happen, okay? But it's going to give you, if there's an error, you would either add or subtract for the error depending on what needs to happen. And that's going to give you a balance, okay? Then you're going to do the per books balance, okay? And the per books balance, you start with what your T account shows for the same date. So if you're doing your bank statement and your bank statement says October 31st, you're going to look at your cash, your T account for that account for October 31st. And that's going to be your balance that you start with for the books, per books. Okay, then you're going to add for any money that the bank has collected for you. So any accounts receivable, any notes, any money that the bank's collected for you. You're going to subtract for what they call NSF checks or non-sufficient funds checks. So those are checks that have been written to your company that there was not money to cover those checks. So the bank took the money out of your account. You're then going to subtract for any service charge or any other payments that were taken out of your account. And then you're going to add or subtract for company errors, okay? And generally what you do is you do all the additions together and the subtractions together. So if you had to add for company error, you would probably do it right after you did the money that was collected from you, for you by the bank. If it was a subtraction, you would do that after the service charges, okay? So what we're going to go through and we're going to actually do it. Now, the key is that when you get to that balance, the balance per bank statement after you go through the process and the balance per books after you go through the process should be the same balance. Those two balances should agree with each other, okay? All right, so we are going to do a bank reconciliation together on here. And we are going to be using the information for Laird Company. So this is on page 7-21 in your book. And you're going to want to look at that because once I go to the next slide and we walk through the bank reconciliation, you're not going to be able to see this slide once I turn the slide. So you're going to want to go to 7-21, and on the bottom there, you'll see it says Bank Reconciliation Illustrated. And it says Illustration 7.7 presented the bank statement for Laird Company, which the company accessed online. It shows a bank balance per bank of $15,907.45 on April 30th. On this date, the balance of cash per books was $11,709.45. Okay. All right. So we're going to go to the next slide. Okay. Now, you're not going to have all this when you start. It's going to be all blank. Okay. So you're going to start with the cash balance per bank. And if we look at the problem, it tells us the cash balance per bank was $15,907.45. Okay. The next line you're going to put, it's going to be add. You have to have the word add deposits in transit. And if you look at the problem, what you have to do is this one's showing you like step 1, step 2, step 3. Your problem's probably not going to put it in order. So you're going to have to go through and search for deposits in transit. So this one here shows step 1, deposit in transit, April 30th, $2,201.40. So you're going to put $2,201.40 right underneath the 15,000 number. Okay. Then you're going to put less outstanding checks. Now, you may have a list of checks that you have to on your T account. Let's say you have 15 checks on your T account that were written. You have to compare those checks to what shows on your bank statement one by one. You're going to have to do that in your homework problem. One by one, you're going to have to compare the checks in order to figure out what checks in your T account have not cleared the bank yet. And those are going to be your outstanding checks. And you have to subtract that from the bank statement amount because you've already spent that money, okay? Now, I saw a question that came in and I didn't answer the question yet, so I'm going to answer it right now about Wiley wants you to put like parentheses around this $5,904, which means subtraction. So it would look like this. This would mean subtraction, okay? In accounting, you put the parentheses around it, that means subtraction. However, you've already said the word less. So since you've already said the word less, you do not have the parentheses, okay? It would be one or the other. And in bank reconciliation, you always put less outstanding checks, okay? So you're going to put the outstanding check amount down, $5,904. So what you're going to do is you're going to add the $22,0140 to the $15,907.45. You're going to add. Then you're going to subtract the $5,904. And that's going to give you what they call the adjusted cash balance per bank of $12,204.85, okay? Now we're going to go to the bottom part. So you just kind of forget that part for a minute, okay? Now we're going to start with the cash balance per books. And they tell us that it's $11,709.45. We're then going to look through the problem and we're going to see, hold on, if there's, we're going to go through and see if there's any money that the bank has added to our account. If they've collected a note for us, if there's any electronic transfers, any money that's coming into our account. So in this problem, if you read down the problem, it says other deposits, step 1, reconciling items for the books. Unrecorded electronic receipt from customer on account on April 9th determined from the bank statement, $1,035. So you would add for the electronic funds transfer. You're then going to go to the next step. And remember how I said if there's an error, right? If it's an addition error, that would come next. If it's a subtraction error, it would be on the bottom with the subtractions. So if you look at check number 443, it tells you, let's see, what does it say? 443, okay. Actually, it's in step 3. It says, company errors. Check number 443 was correctly written by Laird Company for $1,226 and was correctly paid by the bank. However, it was recorded as $1,262 on Laird's books. So you can see they transposed the number. It should have been 1226, but they put it in their T account for 1262. So you have to figure out the difference, and then you're going to be adding that money back to your account because you took out too much money from your T account. You took out 1262 from your T account. You only should have taken out 1226, okay? So the difference is $36. You're going to add that $36. And it says add error in recording check number 443, $36, okay? Your next step is you're going to look for any non-sufficient funds checks. Now you're generally going to have in your problems an error on the bank side or on the book side. You're going to generally have a non-sufficient funds checks. Maybe you'll have a fee. You may not. You may not have any non-sufficient funds checks, for instance. Now in this problem, it says returned NSF check on April 29th for $425. So you need to subtract that from your books. Okay, your books is your T account. You need to subtract the NSF check for $425.60, so less NSF check. You're then going to subtract for any fees. And this says that there's a bank and credit card fee of $120. So less debit and credit card fees, $120. And then you're going to subtract for the bank service charge of $30. So less bank service charge, $30. And when you go through and you do all that math, the adding and subtracting, you're going to get $12,204.85. Same as what you got at the adjusted cash balance per bank. This is called adjusted cash balance per books, okay? Now, you don't stop there. You have to do some journal entries, of course. We're not going to get away with this without journal entries, right? Now, your journal entries, you cannot go to the bank and change their T account, right? So you can only change your T account. So what you're going to be looking at is if you look at the screen here, everything at the bottom that I just highlighted is something that you have to do a journal entry for. If it's an add, you're going to be debiting cash. If it's a less, you're going to be crediting cash. Okay, so we're going to look at each one of these. You know that cash is going to be part of the entry. So what you need to do is figure out what the other part of the entry is. Okay, so let's go through and look at those. So the first one, collection of electronic funds transfer. So this was a payment from a customer. So you're going to debit cash, $1,035, and you're going to credit accounts receivable, $1,035. If you look in your book on the top of page 722, you're going to see the bank reconciliation, and then below that, you're going to see these entries that we're looking at right now. Okay, page 722. We're then going to go to the next journal entry. Book error. So we made an error on the book, right? We debited cash. So it was for a payment that we made to a supplier. So that means it would have been accounts payable. So we're going to debit cash, $36. We're going to credit accounts payable. The next one is the non-sufficient funds check. And generally, when we have a non-sufficient funds check, that means a customer has paid us. So we need to put it back to the customer's account. So we're going to debit accounts receivable, $425.60, and then we're going to credit cash, $425.60. So if we go back over here, let's see, what else do we have to do? We have our bank charges. So we have the two different bank charges, right? We have $120 and we have $30 for the bank charges. And they just put them all into one called bank charge expense. So we're going to debit bank charge expense, $150, and we're going to credit cash, $150. Now, the thing that happens is if you run a T account on paper and you do the debits and credits, what you started with for your cash T account, and then you do these debits and credits on the T account, you're going to see that the balance you get, the $12,204.85, is exactly what the bank statement showed your adjusted balance for books should be. Remember, if we go all the way back here, $12,204.85. So I always suggest that you run a T account on paper in order to verify that your account is correct. Okay, so I'm going to stop the recording right there.